want this to be, as Gary said, something that you can walk away with today and say, I've learned something that can help me here. Because investing money and how to invest and when to invest and why to invest is crucial. So Jack Hooper, you're the leadoff hitter. So how can retirees or near retirees like Ken Stites earn enough on their investments to meet their expenses during a prolonged period of zero-bound interest rates?
Well, that's a great question, very relevant today. As most of you know, cash, or near cash equivalent, is very repressive. If you've looked at your rates on CDs, your money markets, and the interest is not enough to cover expenses. And so we term that as being repressive, meaning that the interest is not enough just to keep up with the normal cost of living, much less generate income. And so cash has really been, traditionally been one of three pillars that portfolios were built on. Today is not even really a pillar that you can utilize to generate income. That has pushed people out into other markets and taking risks that they otherwise would not take. And so the key is to be able to generate reasonable amounts of income. And we have to begin to look at alternative places where that income can come from. Reasonable income today, I'd say most experts would say, 4% income generating above the inflation rate. We have very low inflation today. That's likely to change. So where can we derive income? The best way to never run out of money, the very best way, is never to have to sell your underlying capital, your shares, your investments, but to generate sufficient income off of that. So today I would broadly say look through the world. There's many places outside the United States and inside the United States that can generate stable income of that 3.5–4%.
Okay, David Scalzo, what's the best investment strategy to have during volatile markets?
First and foremost, I think you have to have a really good relationship with the person that you're working with. You need to communicate with that person so that your advisor knows exactly what your expectations are, what your risk is, because if he doesn't know what your risk tolerance is, then he can't formulate a plan around that for volatile markets. The second part to that answer would be, there's all different kinds of markets, right? You have bull market, which is a rising market. You have a bear market, which is a down market. And then you have a volatile market, which is kind of like this, which is kind of what we've experienced over the last 3 and 4 months. In that active management, I'm going to use the word active management, meaning get yourself or your advisor getting you in the fastest moving lane. So fastest moving lane meaning where's the money being made? It doesn't matter what market you're experiencing, there's always money to be made. And so if you can get yourself in that fastest moving lane and maybe have most of your money or be diversified in those faster moving lanes versus the slower moving lanes, you set yourself up to be successful.
Okay, Justin, good question here. Is a penny saved really better than a penny earned?
I'm going to go the more practical route to investing. And so some of you are probably thinking a penny saved better than a penny earned. Well, most of you are thinking I have to earn $1 before I can save it, right? Most of you are thinking that probably. So you're probably thinking the question's bogus. But whether you're an employee or an employer, you should have some options to put money away towards retirement on a pre-tax basis. And if you really do save money on a pre-tax basis, you no longer have that as earned income that you can live on, that you can spend, that you can make bills. So if you actually remove dollars from your income tax return, there's huge tax savings. So that's one of the whys to investing. Not all investments give you tax savings on the way in, but one of the biggest tax savings is putting away money on a pre-tax basis into retirement. Depending on your income, you're taxed on a marginal basis. And so if you don't make a lot, you're not taxed a lot. The more you make, you marginally are taxed at higher rates. When you put money away on a pre-tax basis, you're taking money away from the top tier. And so for a lot of you in the room, you're taxed at 25% federally and 8-9% state. That's 33, 34 cents on the dollar. So if you put $1 away in a 401k plan or 403b or a 457, your actual paycheck would only go down by about 65, 66%. So that's a really neat way and a real big reason for why to invest. Now, if you're a conservative investor, once it gets into the account, you don't have to pick a whole stock portfolio. You could even leave it in cash and still capture the tax benefits. And so anyways, one of the reasons why to invest is to save money on taxes. And for a lot of you W-2 employees, besides mortgage interest and charitable giving, pre-tax retirement funding is the only way you could really save on taxes.